My first question is, a lot of people teach us how to buy. I would like to know your philosophy on how to sell, or when do you sell?
Right.
Because from childhood we've been taught to buy things in the shop. We've never been told to go and sell something. So it's very difficult. And the second question is that very few people are lucky to have the float of an insurance company like you and Mr. Buffett have. And in India, a lot of capital misallocations keep happening at the promoter's end, which does not permit you to own a stock forever kind, like buy and hold strategy that Mr. Buffett always tells us to do.
Mm-hmm.
So there's always this challenge in our minds whether we have to always look into that sense. Would you still say in the Indian context that buy and hold is the right strategy, or you have to keep churning for the cash flows and for other compulsions of the market?
Sure, those are great questions. Well, I would say that selling is more difficult than buying. It's usually easy to get into things. It's a little harder to get out. Just a few things that I do is that, and these are just, I think most of this will be naturally obvious to all people, or most of you, is that if you are operating within your circle of competence, then you understand the business, and if you understand the business, you understand what it's worth, and you would have a good idea. So if a stock is trading at 50 rupees and has a market cap of 200 crores, and you understand the business and you think it's worth 500 crores, then it's a set of metrics you have very clearly in your head. And I usually write up about a paragraph of what my perspective is on the stock and what I think the intrinsic value is and why I think it's worth that, and usually in very simple English terms. And that I do that before I buy. And usually I'm looking to sell at about 90% of what I think is perceived intrinsic value. And usually I'll go back every 3 months or 6 months and update my thoughts and perspectives, because the company may have had some developments, and at least once you get past a year or multiple years, intrinsic value may have changed, and hopefully it has increased, and then you can accordingly update intrinsic value and accordingly update what you think the sell price should be. And so it's it gets down to the basics of Graham, which is you're not buying a stock, you're buying a business. So some basic things just to keep in mind, that you always approach it from the perspective as if you're buying the entire business. So if Apple has a market cap of 700 billion, the question to ask yourself is that if your family had 1.5 trillion in wealth, for example, would you be willing to buy the entire company Apple at 700 billion? And if the answer is yes, then invest in the stock. And if the answer is no, then you shouldn't even buy $100 worth of Apple stock. So the mindset of looking at it as an asset versus a stock is important. If you understand what the intrinsic value is, then you're also there. And of course, there are mistakes in investing, and mistakes actually are quite numerous even amongst great investors. And so, whenever it is obvious to you that you have made a mistake, then you can reevaluate. One of the things I use as a circuit breaker for myself, just to make sure that I'm not kind of trigger happy, is usually we tend to get self-doubt about a stock, especially when it declines in price after we buy it. And my own history is most things I buy, they know I've bought the stock and they proceed to decline immediately after I bought. Has that ever happened to you? Okay, just you and me, nobody else. And so what I do is that to counter any urges to take instruction from Mr. Market on value is I just use a rule where I'm unwilling to sell a stock at a loss until at least 2 years have passed from the time I bought it, and present intrinsic value has to be below present stock price. So it has to be very clear the present intrinsic value is below present stock price, and a significant amount of time has passed, so that you've kind of shaken out any kind of market-driven psychology that may be driving you. And well, the second part is that which is buy and hold versus trade in and out is I think a market like India is a market where there is the possibility of having very long runways. There's a possibility of finding relatively small businesses that have long runways, high returns on capital, good management, and have tailwinds. And the very best investments would be not investments that are cheap from a quantitative perspective, but ones that have those types of dynamics. There's a runway to which business could be worth 10 or 20 or 30 times in revenue in 5 or 10 years, and such. So I think that if I were in India, that would be my primary focus, is to try to find. And I think the markets here are very different from US markets in the sense that it to some extent it becomes very heavy like PE, private equity investment. You have to do a lot more work in terms of understanding the nature of management and ownership and so on. But to the extent that you can identify those long runway opportunities and you can identify them at prices that are quite reasonable, then I think that's the way to go. The buying and selling is also perfectly fine, but I would say do it within the context of that you own the business and you think of it as owning a business versus owning a stock, and look at whether you're buying and selling the entire business and whether the price at which you're buying or the price that you're selling is a rational decision both ways. So that's my 2 cents on it.